So before I even go into my spiel why I'm not buying any real estate for investments right now, I don't know if you guys have even seen this video circulating, but listen to this guy. He's a mortgage broker and he's going to tell it to you straight up. Here, let me get the video.
That's disappeared. There's no more leveraging to buy additional properties. The numbers don't make sense. The HELOC rates are too high. The mortgage rates are too high. The property prices are too high to buy rentals. And the mortgage math of buying an investment property or keeping your old property and buying a new property to live in, all of that math has gone sideways. It's just not manageable anymore. It just doesn't make any sense. So that segment of the marketplace has vanished.
And I mean, you can't even turn on the news or look at any financial news, and all you're going to see is negativity with housing in the mortgage industry right now. I mean, look at this. And this. And this. I mean, everywhere. It's all not a good situation for housing. So given all of those reports, whether it's builder sentiment, new home sales, resales, everything right now is predicated on the interest rates. Now, mortgage rates continue to fall, but if you saw in that video, Mr. Butler is telling you, for any investor, institutionally or recreationally, mainly for us smaller players, we're going to typically leverage on a 30-year mortgage. And unfortunately, when you are computing, and I'm not talking about ROI, and we'll do another video on this, I'm talking about ROE, and a lot of people don't even know what that is. Return on equity is what we are typically focusing on when we buy a rental property. And we also use other formulas like internal rate of return and net present value. But to keep it very simple, ROE is what we are doing with our money, leveraging with other people's money with the bank. A lot of times that's 70-30, 80-20. So you're putting 20% down, the bank's giving you 80%. So right now, the cap rates or the rate of returns on those types of borrowing rates, they just don't compute. It's just not worth it because there are more attractive returns that are in risk alternative investments like T-bills, treasury notes that are paying you well above 4.5%. I mean, look at the 6-month T-bill. It's paying you right around 4.6, 4.8. I can't remember in today's trading. So why take on the headaches and the risk premium that comes with investment property when you can get a better return just on a risk-free note? That's why I am out of the market. Tell me what you guys are doing in your market. You know, my market here in Phoenix is definitely out of the question, but I'm curious to know how y'all's markets are going. Let me know in the comments.